Thank you very much, everybody. Thank you for joining us for the AICDP event, looking at the ever-changing trading conditions. We were hoping we would be able to network with you all in London, but unfortunately, the rail strikes that are due tomorrow, I think it is, sort of put paid to that. So we had to quickly revert online. So we do appreciate you joining us, and we do hope to get back together face to face. I think we've got a 30th of November planned in for our next event. So we will keep you posted of what the agenda is looking forward for the future. So today, I'm delighted to be joined by Dr. Rebecca Harding, who's going to be speaking to us all about the ever-changing economy and what that means as credit professionals going forward. And I'm delighted to also be joined by Richard Talboys, who's going to be doing a credit insurance view of the current trading conditions as well. And I'm also joined by 3 AICDP partners who are going to be introducing themselves very, very shortly. So I shall just hang fire on introducing them. But they'll be giving you an insight into their businesses very, very shortly. So we're going to be together until about 5:30. We hope that you've got lots of questions. If you do have any questions, whether that be for any of our corporate partners, whether that be for Rebecca or Richard, please just pop them in the chat and we will make sure that we get to all of your questions, and we will ask you to unmute as well so that you can ask your question to make sure that it's all covered on the call today. So please make sure you've got those questions ready. So the agenda is on the screen. We're going to, for those of you who are not already AICDP members, I'm just going to take a few minutes to tell you a little bit more about how you can become a member and what that means for you. And then I'll be handing over to our corporate partners for their presentations. So we'll get started. So AICDP was formed in 2014 to bring together the credit community, to look at the DNA of a credit professional, to look at the support, the help that credit professionals, directors need, whether they're working in the UK, whether they're working across international borders, and to actually create an organisation that offered that help, support, get those questions answered, but also look at the career progression. So we're currently, well, this slide is a little bit outdated because I'm delighted to say that we're over 500 members now. We reached that milestone about a month and a half ago, 2 months ago now. So we're 500 members strong, and it is really a global audience. On the last sort of review and audit of our numbers, that was across 19 countries that we've got members participating in AICDP, and we do have a lot of help and support across international borders as well. One of the things that I think is very, very strong for AICDP is the credit community. We have an active membership where we meet. I know COVID has put paid to some of our events, but we have been meeting online. We have been meeting online and networking, and we have got a lot of events planned in the foreseeable future. But the credit community is something that our members tell us that they find quite a strong proposition for becoming members of AICDP, because it means that they can ask questions, they can get the help and support they need outside of their peers, their industry, and they can get to the nitty-gritty of what they need, because our members and our corporate partners who support and underpin AICDP have got a wealth of experience and a wealth of knowledge in a vast array of areas that cover the whole essence of credit. Also, membership is free, which I think is a fantastic opportunity to become a member. Not only do you get the webinars, not only do you get to come and join us when we are face to face, but we also have networking opportunities, and we also are speaking more. I don't know how many on the call today are going to be over at the World Credit Congress in Dublin next week. But AICDP will be speaking at that Congress. We will be hosting a panel discussion on day 1, and our partners have sessions on day 2 as well, which I'm sure they'll tell you about shortly. So we do get involved not just in our own events, but other events going on across the whole of the credit community. So if you did want to become a member, you will see there's a website address in the bottom corner. If you visit that website, there's a membership tab, and if you just pop your email, your name and your company in that, we can get you registered so that you receive all of the information about AICDP, whether that be about how to join the community, any education and training sessions that we're running, any events and any webinars that we've got planned. So I would also just like to take a very few minutes just to say a big thank you to our corporate partners who make AICDP the organisation it is today. We're very proud of our corporate partners and their knowledge, their strength, and the work that they do within the organisation is really testament to the names that you can see on the screen today. So thank you very much to all of our corporate partners. That slide is just saying that, again, you can drop an email to info@aicdp.global, which will come through to myself and Bill Dunlop. And again, so if you are interested in becoming a member, or your team, you might be interested in getting your team enrolled in the AICDP membership, just drop me and Bill an email on that email address, and we'll make sure that that's processed and gets you all up and running and sends you your membership numbers. So that's me. I'd now like to take a few minutes just to introduce, we've got 3 corporate partners on the call today. Simon, CEO of Copilot, I'm going to hand over to you first, if that's okay, if you would like to take 5 minutes to introduce your business and tell us a little bit more about the work Copilot is doing and also your Essence of Credit Risk events.
Okay, shall I go now?
Yes, please.
Okay, hi everybody. I think most of you know us. We advise companies about credit risk management, best practice, credit management technology and software. We have a big focus on risk, on scorecards, on information sources, on red flags, all sorts of things. And we run a series of events called the Essence of Credit Risk. They're very high level. They're aimed at credit risk professionals, usually credit director, senior credit manager, or senior analyst level. And the idea behind them is that they're short, sharp and high level. And we have a series of events that we'll be planning over the next year or two, covering all sorts of topics. We ran one in London a couple of months ago, which we're repeating in Dublin next week. And we looked at 3 things. We looked at a case study, which was Debenhams. And one of our event partners for that was COFAS. And we had a timeline and a study of all the things that happened with Debenhams and what were the warning signs, what was happening. We had some clients in the room who'd been very heavily involved in Debenhams and had further insights to add. And we also had a banker in the room who'd been involved on Debenhams. So you can probably imagine it was a very strong discussion. One of our clients had picked up an early warning sign that he'd learned from an earlier Essence of Credit Risk event. And he'd gone to see them, a very strong guy, this guy. They wouldn't give him management accounts and he pulled his 3 million limit. COFAS, when going through their timeline, had been able to get management accounts because Debenhams needed to keep the support of the credit insurers. And of course, credit insurers, their whole business is trying to understand the risks, not just producing financials on them. And we then got into a discussion about, well, how do you manage all the different sources of information? Because nowadays you can't just rely upon historic information. You need to understand your risk and what's happening to your risk, and you need to have the answers. And that led into a discussion about what are the real challenges that are coming up for credit risk management. And they're all related, but you've got geopolitical events, which is having a big impact, obviously. You've got supply chain disruption. One of our clients, their global economist, said it's changing every day. It's coming at them from different directions every day. And you've also got ESG, which will affect credit managers to varying degrees. Some people think it's a long way off, but it's not. It's when you get the phone call from the CFO to say, do you know who these people are that we're doing business with? And all this puts huge pressure on credit risk managers of what information do you get? What types of information do you need to have? How do you manage them? What are the important red flags? How do I stay on top of all this? And that was what we talked about. And we'll be talking about it again in Dublin. We'll have a bit more to say because things have moved on when we're in Dublin. And it was a great meeting, and the atmosphere in the room afterwards, you could almost, it was at the 8 Club, you could almost feel it. And they are good events. We've had 4 global heads of credit tell us it's the best event they've ever been to, one of whom is in the audience today. So if you're able to get to Dublin, obviously it's short notice, but if you're going to be there or you're able to get there, it would be good to see you. And otherwise, just keep an eye on what we're posting and maybe try and come along to one when you can.
Thank you very much, Simon. Right, David Boots of Co-Credo, could you unmute yourself and just tell us a bit more about the work Co-Credo is currently undertaking?
Yeah, absolutely. So first of all, Dan sends his apologies for not being here today, but he's had a quick chat with myself yesterday, and he wanted me just to give sort of you guys a quick update really on what we've been doing. So first of all, we're sort of very proud to be celebrating 20 years in business this year, and proud to obviously reach that milestone with hopefully many more to come. We are investing a lot more in forums and trying to be part of those sort of crucial focus groups to receive you know, that vital feedback from our peers. We're also doing a lot more with our user security, excuse me, and enhancing our sort of our user journey through our integration, which is XML, and also working and continuously evolving our customized scorecards. We've also secured secured long-term relationships with our key international data providers, which obviously means we can continue to still give the best data in the market, whilst, you know, diligently still testing new providers to potentially work with them in the future, which is constantly evolving. And then lastly, Dan obviously wanted me to mention that it goes without saying that we are very proud to be a partner of the AICDP. You know, please feel free to get in contact if we can help with anything in any way.
Perfect. Thank you very much, David. Thank you. And Vil, thank you very much for joining us. Can you unmute yourself and sort of tell everybody a little bit more about SHS Viveon?
Of course, Claire. Good afternoon all together. Wim Schwer, SHS Viveon, Germany. It's a pleasure having you all with me today. So what are we doing? SHS Viveon is in business for more than 25 years, doing nothing else but credit risk management and credit application management on a highly automated level. SHS Viveon provides several platform solutions to connect processes all together, breaking silos within large corporates. Meaning that we can connect to any sourcing system which is in the market with standard API if this is required, or with any data exchange that might be available on client side. We connect internal data to external data like Co-Credo, for instance, and others as well. And there is a big and high focus on connectivity to trade credit insurances. All the major trade credit insurances are fully connected into our platform. SHS Viveon comes along with a little bit of deep understanding of credit management and complex processes in large corporates, and that is what we do. We just make things working there. A little bit of an outlook, where are we heading to? It's not only credit management what we see. We see many changes happen right now related to supply chain topics, for instance, supply chain compliance, ESG scores, which are about to be part of decisioning patterns in the future, and that is what we are preparing for. That is a brand new branch of SHS Viveon, which is just coming up as well. So generally, we cooperate with a lot of partners like AICDP and Copilot and CoCredo, and we fully engage in the partner network. We think that the partner network is mostly good in finding best solutions for clients. That's SHS Viveon.
Thank you very much, Phil. Really appreciate you joining us from Germany. So without further ado, I am going to welcome Dr. Rebecca Harding to join us, CEO of Coriolis. And she's an independent economist specialising in trade finance. And we're delighted to have you back, Rebecca. You joined us last year, and the feedback from your sessions from our members was fantastic. So I'm really looking forward to hearing from you again. So I'm going to welcome you to take over.
Thank you very much indeed. You've made me a hard act to follow. What I want to do today is talk to you about the global economy and trends in international trade, because obviously credit insurance behind international trade is incredibly important. And what I want to do is give you an overview of where I think the mega themes are in the coming year, towards the end of this year and into the coming year, and how we've got to that particular point in time. So if I just start on a cheerful note, because after all, it's a damp Tuesday afternoon, and why aren't we going to be cheerful? I think it's fair to say that where I left off this time last year, the world has gotten noticeably worse. So I talked at the time about trade being weaponized. What I meant by that was the fact that trade itself was being used as a tool of foreign policy. It's always been a tool of foreign policy, but the problem that we have now is that it's actually being used strategically. So it's being used by governments, and that's creating the very political risk, geopolitical risk that was referred to earlier, because what it's doing is it's adding a layer of sanctions, it's adding a layer of embargoes into the mix for trade and trade credit practitioners. And what that means, of course, is that every single day the environment in which you're operating changes. One day it might be fine to trade with a certain individual, the next day it isn't. One day it might be fine to be trading in a particular product, the next day it isn't. And so that whole system has become a lot more volatile and a lot more risky. So this whole area of weaponization of trade has actually created and built a difficult situation, and it's been building actually since 2016, maybe even slightly earlier than that. But it's become something that we have to keep our eye on, because if you talk to people in the security services and so on, it's actually what they're all talking about. How we need to understand more about trade, how we need to understand more about trade flows, because it is a big issue of our times. Now, somebody's already mentioned that critical supply chains are threatened. And again, this is a volatile issue. It's been building up through the pandemic. You could actually argue as a result of the restrictions and everything as a result of trade restrictions before the pandemic, that some of our semiconductor supply chains were already under threat. You can see some of the issues with our supply chains going back to the relationship between China and America back in 2017, 2018. So this is part of a longer term pattern, but of course COVID has made it worse, because we've had stuff not being able to get into ports that have been shut down and so on. But now, of course, we've also had that we're still seeing the aftermath of the Suez Canal, and we've still got problems because of Brexit, knock-on effects across Europe. And of course, the conflict in Ukraine is affecting supply chains around oil and gas, and also affecting supply chains around soft commodities as well, particularly cereals and oilseed. Now, the other thing that's going on at the moment, if I haven't made everybody cheerful enough yet, the other thing that's going on at the moment is that China's economy has long COVID. Now, I say that slightly tongue-in-cheek, but China has not unlocked its economy yet. China has a huge amount of debt on its balance sheet. It's got across its Belt and Road, it had massively invested across the Belt and Road. And the fact that it hasn't opened up yet after COVID means that it's not generating the amount of revenues that it needs to generate in order to be able to keep that level of debt sustainable. So China itself actually has a lot of economic issues that have come as a result of the COVID pandemic, and obviously the weaker housing market and so on. Now, I'm starting to move into the current times and into oil and gas prices, which are fueling inflation. That is undoubtedly the case. It's obvious out there that energy prices are creating a very real cost of living crisis for everybody. You've got to add in food and clothing as well into that particular mix, but it is a fact that there is, people are calling it a weaponization of energy and a weaponization of oil and gas and commodities. Part of the whole picture, of course, is the Russia-Ukraine crisis, and because the impact of sanctions and embargoes has been really to unintended consequences of inflation across the allies who had imposed those sanctions. Those unintended consequences are now very subtly breaking down some of the alliances, particularly within the European Union. So these prices are likely to rise considerably more. It's creating problems. We all know that. It's not the only thing, though. It mixes with everything else. And that all of that means that global economic conditions are tough. There's no simple way of saying it. So it depends on who you read, whether or not we're going into a recession, whether we are in a recession, or whether we will be in a recession next year. But obviously what that does is it says quite clearly risk and uncertainty is not going away soon. Whichever way you look at it, it's quite difficult to come up with a glass half full perspective on what we're doing at the moment in the global economy at the moment. As I probably said last year, and as I say very often when I'm asked the question, when will everything go back to normal? It won't go back to normal, because the Russia-Ukraine crisis has changed everything in terms of the way in which the global economy is operating. There is no normal to return to. The fact that Russia is now outside of the economic context and it needs to be brought back in again means that this is going to take a long time to recover from. So, on that cheerful note, I will move into what I want to talk about today. I want to give you an overview of trade patterns because it tells you a lot about where inflation is coming from. I then want to talk about trade and geopolitics and why trade and geopolitics are so bound together. This is developing the themes that I've talked about before, but looking at it more in terms of strategy and why economics effectively has become a domain of warfare. And then to look at critical components, because this is one of the areas of huge risk that's coming down the track. Our supply chains for digital, for semiconductors, that drive our global economy, but that also drive our transition away from fossil fuel dependency, are very reliant on rare metals, and they predominantly come from China, and if not China, Russia and Africa. So there's a lot of risk and instability there as well. And I do actually want to have a slightly upbeat message to this, because what I'm going to do is talk about making trade sustainable. Now, as has already been said, sustainability is a big mega theme, but a mega trend. But in order to make trade sustainable, there needs to be some big shifts in the way in which the global economy operates. It's an opportunity, and it's one that we can't fail at. Oops, what's happened there? So I just knocked my presentation, I apologise. So what I'm going to do now is, without further ado, move into an overview of world trade patterns, because this tells you just how difficult it is, if not impossible, to separate trade and economic risk. This is an interesting chart, and interesting and chart might not necessarily go in the same sentence together, but what's interesting about this is that the green line, which you can see, is showing the volumes of world trade since the COVID pandemic. And if I just use my pointer here, it's gone again. This is very sensitive. If I just use my pointer here, you can see the obvious impact on both the volumes of trade and the values of trade at the time of the COVID pandemic. Volumes have picked up, and they've slightly picked up over the last few months, 18 months or so, but they're relatively stable compared to where they were pre-COVID. Just a very slight uptick. In contrast, what you can see here in terms of values, which is effectively the price of trade, is a big dip here associated with COVID, another big dip here associated with the supply chain crisis at the beginning of 2001, then everything relatively static until we reach January, February this year. And suddenly prices have gone up massively. And why has that happened? It's obvious that the Russia-Ukraine crisis has had some kind of an impact on those prices. Now, one of the things that's interesting is that although there's been a slight downtick in April, the impact between February and March was so great that it means that particularly Europe, North America, and the UK are affected. And of course, that comes from supply chain issues, but it comes predominantly from oil and gas. Now we need to ask ourselves then, if it's coming obviously in the wake of the Russia-Ukraine crisis, what is there underneath that we can see that might give us a little bit more information? Now, what this chart tells us is that you can see that China actually had the biggest increases in trade values between February and March this year, but that actually it's not in the chart, but before the Russia-Ukraine crisis started, Chinese prices started to increase. So the index actually went up by 119% between January and March. These are very large price increases. And what it suggests is that there's something around supply chain challenges and China's lockdown that's actually causing a slightly longer term pattern here. The other interesting thing is that it's imports that tend to be more affected than exports. So you can see here the US has had quite an increase in its prices. Some of that is coming from the fact it's very dependent on China for imports of electronics. But then you can also see that actually Germany, the US and the UK are relatively similar in terms of their price increases, so that these economies are behaving in the same way. China and obviously Russia here are the outliers. Now, why is Russia showing a negative trend here? This is because between February and March, everything locked down. So you have actually seen a drop in volumes as well as a drop in values here. So it's interesting. I'll just say one other thing, which is that UK data, which shows the price increase, masks a fairly fundamental drop in shipments during that period of time as well. So that actually is a measure of higher inflation potentially than in the USA and in Germany. Now, what I want to do now is look at the regional picture for this, so the global regional picture, because this tells a very interesting story as well. And what it does is it tells us that internal African trade, so trade between the 54 countries within the African Union and African Continent Free Trade Area, prices have been going up very significantly there, in fact, more significantly than they have anywhere else. Generally speaking, intra-regional trade has been going up more, but the EU and the US saw an immediate impact on import prices, which comes from fuel. And actually, if you look at the European Union here, its intra-regional trade hasn't suffered as much as everywhere else apart from South America. So it suggests that something positive is happening with supply chains and the single market within Europe to help protect the European Union at the beginning of the crisis from the effects of price increases. I'll come back to the African story shortly, or I'll come back to the African story now, because the value of African trade actually dropped back, intra-African trade dropped back right the way from the beginning of the pandemic. You can see the pandemic effects here. It recovered slightly, and then you can see that it's actually failed to recover at all. So this is something that we're seeing on the ground in Africa, that intra-African trade has really struggled to pick up and stay high. A lot of that is to do with the infrastructures that are surrounding trade. But you can see there's been a very big increase in intra-regional trade values here, and you can see the imports into and exports from the region are growing in price as well. The huge increase in intra-regional trade won't help an intra-African trade that's still struggling to recover. So this just gives you an overview of what's happening in one of the poorest regions of the world that's already trying to recover from the pandemic effects, where it saw its first recession in 25 years. Now, what I want to do now is take that into the sectors that are being the most affected, because I think my screen is jumping around a little bit. Let me just go back here, because I missed a slide that's quite important. This is the sector slides, and what this shows is that electronics has actually seen the steepest increase in prices. So this is illustrating what I've talked about with China, that the lockdown is having an effect on supply chains in electronics and machinery, and that actually fossil fuels, which is this one here, is not the price increase that's the greatest. It's electronics, and that is worrying, because again it tells us about the impact of supply chains. Now, if I skip back to where I was, which is the picture in more detail for specific products, if we look at where the biggest price increases have been, it's actually in some of the base components of our electronic sectors. So base metals have gone up by 92%, nickel 84%, copper 72%. Now, who are the main providers of this? China. You've got some elements of South America as well, particularly in terms of copper, but China, Russia, and Latin America and Africa are the main beneficiaries, if you like, of these price increases, but they're also the main sources. So we've got some geopolitical risk that's building within this. And then, of course, because of the invasion of Ukraine and the failure to get oilseed out from Ukraine to other parts of the world, oilseed also went up in price very significantly as well. Now, this side is all about components of supply chains. This is actually about the consumer products and the impact on us as human beings, and where we're seeing the big increases. And this creates an economic fabric that is very worrying, because this is where it's beginning to create pressures on politicians to help us with energy prices and the cost of living. So you can see knitted fabric, so jumpers, and the fabric that goes behind it, increasing well and truly above the average, which was 51%. Footwear going up as well, iron and steel, so all the stuff that goes into construction and rebuilding. And then meat went up by 50%, and interestingly, cereals only 31%. But you can see that on this side, this is all about supply chains, apart from iron and steel, which is also about supply chains. And then this is all about the demand side. This is about us as human beings. So what this side is telling us is we have an issue with our longer term supply chains, and we have an issue with the consumer goods that we're buying just to survive. And this is evidence, if you like, of the cost of living crisis itself. Now, to move on to the next area, having cheered everybody up with that, I want to now talk about trade and geopolitics. And as I said, it really is difficult to come up with a glass half full interpretation of this. Last year, I will have talked about mutually assured destruction, and I'll have talked about how trade is being weaponized. And I'm just going to fling you a quote from the book Gaming Trade, which I co-authored. The prospects of mutually assured destruction has limited the prospects for direct military confrontation between the great powers. In an era of somewhat tenuous nuclear peace, the challenge for states is how to protect national interests and build power. If I stop there, you can think about how the nation states are building their power now, particularly amongst the allies, but Russia is doing the same thing as well. We are at economic war because effectively energy and trade are at the center of that whole process of power mongering between what is now obviously becoming more like the East and the West. And I'd say these weapons are dangerous because what they're doing is they're destroying institutions like the World Trade Organization and the United Nations. And obviously, as they start to undermine economic stability, and as they are undermining economic stability in the way I've just talked about with prices, it starts to affect peace, but it also starts to affect the environmental sustainability of the world as well. So it's impossible to separate trade from political risk and geopolitical risk, but it's also being accentuated by the Russia-Ukraine crisis. And one of my arguments here is that we are seeing economics actually being built into the fabric of strategy in a way that means that economics is now a domain of warfare. Let's have a look at why the Russia-Ukraine crisis started in the first place. And it's all about Russia's dissatisfaction with globalization. But we could have understood a lot of that dissatisfaction a long time ago if we'd looked at the patterns and trends in trade since 2014, when the first Crimea crisis happened. Oil and gas supplies and prices have been manipulated by Russia for a long time now. This isn't a new story. So at the beginning of the COVID pandemic, it was actually Russia walking away from the OPEC negotiations and then a general run on oil, thinking we were running into a downturn that caused the challenges that we saw with oil prices at the beginning of the pandemic. Russia has also pivoted significantly to China, Africa, and the Middle East. So this is something that has been very much in the commentary around the Russia-Ukraine crisis, that there is a risk that the whole system, the whole trade system, will continue to support Russia because of its pivot towards China, Africa, and the Middle East. A lot of trade is going in those directions, and I'd say India as well. It's been doing that for longer than the last few months, though. That's been going on for a long time, and it's been building since 2016. Now, some of the unforeseen consequences of the last set of embargoes are interesting to show you exactly what we might be looking for as an outcome of all the embargoes and things that we've implemented now. So after 2014, the Westporton embargo, or during 2014, the Westporton embargo on oil and gas then. And so Russia switched and has since become the largest exporter of wheat in the world. It wasn't before 2014. In fact, it wasn't before 2016, but it switched its trade policy to emphasize and make the world dependent as well on its wheat as well as on its oil and gas. And so it's had a greater influence over commodity prices and soft commodity prices since then. Over the last few years, 6 years or so, 8 years or so, we've seen an increase in the number of cyber attacks. We've also seen gold and foreign currency reserves growing since 2014. And again, that's very visible in trade statistics. And then one of the other things that's visible in trade statistics is the amount of transport infrastructure that's been built along the border with Belarus has actually been funded by or is visible through the amount of railway infrastructure going into Belarus and into Russia in 2017. And it's incredible that you can see these things, but you can by looking at trade data. And the other thing that's really important, one of the big mechanisms that the West has used to try and restrict finance and financial operations is using the SWIFT system, so the SWIFT messaging system, to limit Russian bank access to international trade. Russia has been building an alternative since 2014. It is hooked into Chinese systems as well. The switch is imperfect, the connections are imperfect, but there is scope for that to expand. And there are 23 countries which, prior to this crisis, were operating on the Russian system as well as the SWIFT system, and one of them was Germany. So it's actually a very contested system. It's still not completely perfect, but it has been used as a mechanism for circumventing some of the embargoes against Iran, for example. It's less popular now, but there is a system there to separate out trade and trade finance and payment systems using an alternative digital system to the SWIFT system. And then just one thing, why on earth have I got a picture of fish here? Well, the reason why I've got a picture of fish here is because Belarus between 2014 and 2016 actually became a major exporter of fish to Russia. Why? It's a landlocked country. Why on earth would it be doing that? Well, it was because the European Union had imposed embargoes on agricultural trade with Russia. And so what happened was we were trading with the Faroe Islands, and the Faroe Islands then traded with Belarus and some of the and Lithuania as well, that then went into Russia. So Russia wasn't as restricted. So you can see a lot of these fairly perverse consequences from the previous set of sanctions. And now we've imposed sanctions on a scale not seen before. So it's not surprising that inflation is one of those unforeseen consequences. So why are trade and economics a domain of warfare? And I just want to skip through this quickly, but it is, for me, the most important thing. If we look at this now in terms of very simple game theory. Game theory is understanding what your enemy is going to do, trying to second guess what the enemy is trying to do, and come up with a strategy to mitigate that and ultimately win. The problem is that it's impossible to tell what President Putin's objectives are. Even now, one day he's saying, I'm going to launch a nuclear attack. The next day he's saying, I'm actually going to tread carefully. So it's very difficult to predict what's going on in his mind. But if we look at this as a set of outcomes in warfare terms, if Russia escalates militarily and the allies escalate militarily, so specifically NATO, the EU, and the US, then the outcome is mutually assured destruction. And this is what the fear is, that any use of nuclear weapons might provoke an equal but opposite response from NATO, and therefore create mutually assured destruction. In a sense, nobody wants that to happen, which is why the West has used economic means rather than military means, except funding Ukrainian military itself. If the Allies stay restrained and do nothing and Russia escalates, then obviously the Allies are weakened and Russia's intentions across the whole of the Baltics could escalate. So the idea has to be to contain Russian ambitions and Russian aggression in its former Soviet Union sphere of influence. So trade and trade finance are really important here, because the goal is to show that the rules-based order and actually dollar hegemony works while starving the Russian military of cash. So what's happening is that we're trying to get to a point where Russia loses. In other words, Russia de-escalates, but the Allies escalate sanctions and supply weapons. In reality, what is more likely is that we will end up with this situation, a long game, if you like, where war and peace coexist, where neither de-escalates, neither escalates, and we end up with a very long conflict. But you can see the role that economics is playing, because actually we're beginning to play in this end game now, which is occasional threats. Nobody really wants to do something nuclear because it would be mad, but in fact, the global economy is being held to ransom. So it is a domain of warfare. So what I want to do now is move on to the role of critical components. And this is something that has been part of a BBC podcast recently with Misha Glennie. So I feel like I started to look at this before Misha Glennie, which probably means that I got there first but didn't get the credit for it. But rare metals hold the key to the way in which the whole new 21st century order will play out. So this is one of the big risks that we're seeing at the moment, environmentally, socially, and in terms of the governance of the global economy. As we transition from fossil fuels, we want smart cities, clean energy, digital trade, and even trade finance. It all relies on rare earths. Everything is dependent on supplies of the 17 rare earths and things like lithium and so on, which fuel our transition to a new sustainable future. And if we look at where rare earths and minerals come from, they come from Russia, China, and Africa predominantly. So if we look at urea and clean diesel, Russia is the largest exporter, China the second, and then the Middle East. The Middle East is important as well. So 50% of the global market moving from transitioning from diesel to clean diesel is controlled by these few countries. If we look at lithium and cobalt, electric power and digital and semiconductors need cobalt and lithium. It's incredibly important in our defense sector as well. The DRC, Democratic Republic of Congo, accounts for over half of the world's cobalt exports. The rest is accounted for by places like Russia, actually. Russia is very important in cobalt as well, but the DRC supplies all of its cobalt to China. In other words, we are dependent on our electric power, not necessarily just because of China and its exports of lithium batteries, but because that relationship between the Democratic Republic of Congo and China, which is effectively the semiconductor raw materials, is absolutely critical to our global semiconductor supply chains. If we look at smart energy solutions, China accounts for 2/3 of the world's exports of tantalum, which are critical for smart energy and warheads. And then if we look at critical minerals in digital and defense, they need rare metals for magnetism. So the 17 rare metals, China and South Africa account for 28% of total world exports. Russia, nearly 20% of palladium. China accounts for about 25% of rare earth metal exports. And generally the supply has been falling, which means that China is actually keeping a lot within its own frameworks in order to be able to keep the semiconductor market under control. So, on a more cheerful note, how do we get to making trade sustainable? Because I think this is both a risk and an opportunity. And I'll just say it here, conflict, regulations, the survival of the planet mean that sustainability is absolutely critical now. The word sustainability can't be associated just with climate change any longer. It's actually far more meaningful. It means peace, it means adhering to regulations, but it also means economically sustainable as well. So I just want to go through what is ESG. It's environmental, social and governance, and it's very commonly associated with the Sustainable Development Goals that the United Nations has put out. I'd argue it goes a lot further than corporate responsibility, certainly in a credit context, and the reason why is because it's not voluntary anymore. It's actually got direct measurements associated with it. And it's hooked into the trade finance system, it's hooked into the financial system, because as I'll say in a minute, financial institutions are having to report on all of this. And we have, wow, help, what's happening? And we have some very crude indicators here. Because the Sustainable Development Goals are actually very broad in their remit. Now, there are ways of measuring against those Sustainable Development Goals, and the principle here with the regulations that are coming in is that finance itself, credit itself, can make the world a better place. In other words, it's regulation in a forward-looking sense rather than a backward-looking sense, which is a big difference from the way in which regulations have historically operated. the regulators are nudging. This can't be voluntary anymore, because we all know that we're not meeting climate change targets. We're not meeting fossil fuel. We're not meeting emissions targets at the rate that we need to in order to prevent a tipping point for the planet. So regulation is actually an opportunity to look forward and encourage better behaviours. Now, why is this an increased risk for everyone here? I think the reason is quite simple. From January 2023 in Europe, financial institutions will be required to report sustainability exposure and risk in supply chains and portfolios. Now, that's actually capital risk exposure. So they will not just need to say what their portfolio looks like, but they will actually need to assess how much capital is at risk in their portfolios from their exposure to climate change, climate mitigation, pollution, etc. And that's what the European Union taxonomy is doing, and it becomes law on January the 1st, 2023. There are guidelines for what needs to be self-reported by businesses and what needs to be reported by banks. But underneath everything, because the Sustainable Development Goals themselves are vague, and because the taxonomy requirements are vague, what needs to be measured within all of those indicators isn't clearly defined. So actually, data itself has become a regulatory requirement, and there are risks that you get the wrong data. It means that there's an exponential increase in compliance costs, of course, but it also increases the risks of greenwashing. So a client coming to you and saying, oh yeah, well, I've got this strategy, or I've got that measurement, or I've got this this approach to sustainable development goals and to reporting, but that actually it's really hard to verify. And as we saw with Deutsche Bank earlier in the year, it means that the regulators have the right to come in and assess risks of greenwashing, or say that a company is greenwashing. And we've seen that across the corporate and the banking sector recently. So what we need is actually a clear definition of what to measure and how to validate it, because otherwise we're going to end up with exactly the things that were talked about right at the very beginning. Your finance director phones up, says, do we know who we're dealing with here? AML KYC says, well, we're not that sure, so we shut off that credit line, or we shut off that financing route. And what we actually want to do is use the regulations to encourage better behaviours. So we have to set in place things that are going to help us not replicate the AML KYC nightmare of the past. Now, what I want to do here is just show you how much of world trade is not contributing positively to sustainable development goals. So if you look here, we've broken down trade, and we've matched the products in international trade to the sustainable development goals. Now, this isn't our methodology, it's the United Nations methodology, but we've applied it across a massive data set. And it's really interesting because you can see here, actually what supports trade, the things where we all sit around and say, isn't trade a great thing, like innovation and economic growth, we actually do rather well. The things where we're actually having a negative impact on the environment, minus 0.73. In other words, trade is predominantly, the structure of trade is predominantly tipped towards negative, where -1 is all trade makes a negative contribution to SDGs and +1 is positive. And you can see here socially it's minus 0.91. In other words, nearly all trade, except in the largest economies, is contributing negatively. And you can see why here. 34% of international trade is negative against zero hunger, negative against 16% negative against responsible consumption, 14% against negative against affordable and clean energy. These are all things that we probably know if we look out of the window. But it gives a few numbers and a few ideas of just how exposed the world is to these types of risks. And what's interesting is that what we're really doing is we're looking at the structure of trade. So G20 countries are almost uniformly more negative in all of this than the poorest countries in the world, because of the consumption patterns. In other words, they're not consuming as much of disposable electronics in particular. So what does all of this tell us? We can create a score that doesn't discriminate between countries, but it also tells us that consumer patterns are driving weaker scores in high-income economies. But it gives us some policy levers and it gives us some tools so we can start looking at those sustainable development goals in order to be able to give us a better idea of the structure and the areas in which we can incentivize our products to improve contributions positively to those sustainable development goals. And this is just a start of methodology. It's not the end point, but it gives us some useful insight. So just in conclusion then, what I want to do now is just go through the biggest trends in 2023. So let's see if we can be positive. What are going to be the big risk trends in 2023? So here goes. I'm not going to be positive, right? I've given up. Inflation and recession, I think we can run from this one, but we can't hide. I think it's fairly clear that we're teetering on the brink of recession globally. Inflation everywhere around the world is almost endemic now, and you've seen that through the trade figures at the beginning of the presentation. But what's important about inflation is that it's beginning to kick into some of the emerging economies. So it's very high in Nigeria, for example, 20% since the beginning of the year. This is on a scale not seen before, and a lot of it is the unforeseen consequences of the Russia-Ukraine crisis. Is the Russia-Ukraine crisis going to come to an end? As I said, I really think it won't. I think we're likely to see the nature of modern warfare is really war and peace coexisting. It's the conflict might rear its ugly head somewhere, but actually it's being fought in economics terms rather than military terms for a while. We're going to see that coexistence of war and peace, great power conflict, and that will create uncertainties because a lot of that is coming through the sanctions regimes now. We've got Taiwan and China down, maybe as something that might affect our stability during the course of next year. And again, the most likely way in which that might play out is rather military conflict through sanctions as well. And that then has an impact and a knock-on effect on inflation and recession. We also have a big constraint around supply chain and resources, and that's what I've tried to show with the rare metals supply chains part of this presentation, that in actual fact our supply chains and our resources are very dependent on the rare metals and the rare earths and the limited critical minerals that we're beginning to see more and more restricted and more contested in geopolitical terms. And the reason why that's important is because it stops us transitioning away as quickly as we might want to away from fossil fuels. And just to finish then, ESG, I think, is the one area where actually we could look to the future, where actually we can use our day jobs to price effectively in order to manage a transition away from what we're doing now to a more sustainable future in international trade and trade credit and credit more generally. The only problem is that because a lot of our resources to do that are geopolitically constrained, there's obviously a challenge, and there's a challenge because it's also inflationary. So all of these things are interrelated. I wish I could end on a more cheerful note, but I think next year is going to be the year of unforeseen consequences. Thank you very much for listening.
Thank you very much, Rebecca. I really found that useful. I hope you did too. Now, Rebecca will be staying around to answer any questions you do have. So if you want to pop a question in the chat facility, I'm sure we'll come to questions after the next presentation, if that's okay with yourself, Rebecca.
Of course.
Perfect, thank you. So please pop your questions in the chat box. That would be brilliant. So without further ado, I'd like to welcome Richard Talboys, Executive Director of Willis Towers Watson, to take the stage. And Richard is going to be talking to us about his wealth and experience in trade credit insurance and the export finance market. And Richard's been helping clients over the past sort of 20 plus years with very complex trade credit and political risk insurance policies. So I'm sure Richard will be sharing his expertise with us today. So Richard, over to you.
Thank you, Claire. Thank you, Rebecca. As you said, that's a hard act to follow. I'm no economist, although I think this slightly overlaps, or in fact very much overlaps, with the trade credit insurer's view of the world, which is actually my subject today rather than my trade finance experience the last 20 years. I don't think you want my CV for the last, actually I have to admit, 40 years, so it could take all day. But thanks, Rebecca. Very alarmist. I think our trade credit insurers would probably go home and shut up shop if we take everything there, because actually the story is the same but very different in many ways. So much of what you say overlaps. It impacts directly on our trade credit insurers and their view of the world. But before I do that, I just introduce myself a little bit, slightly refined version of that. I've spent most of the last 20 years working with the excess of loss trade credit insurance world, which is a slightly different way of looking at trade credit insurance, very much in partnership with good credit management. So very much aligning with good credit management, which is hence my interest in the AICDP. I'm joined on the audience by Scott Morrison, my business development director and colleague, who's just joined us from the insurance market, where he underwrote that excess of loss trade credit. So has had a lot of experience in working with a lot of companies with develop best practice credit management. But before I do that, I want to give a shout out. I saw on LinkedIn yesterday the appointment of a new credit director, and given this is the AICDP, I'd give a shout out to Louise at Midwich, who seems to have been made credit director. Well done, Louise, congratulations. She was on the audience earlier. I haven't checked in the last 10 minutes.
Thank you. Slightly embarrassing, but thank you.
Apologies for that. What we want to do, I've got to press 2 buttons here. Have you given me control, Claire?
Yeah.
Somewhere?
Yeah.
Oh, there it is. Okay, yeah. Got it. And that's not me or any of my colleagues, that's our standard slide pattern. The agenda today, I want to talk about credit risk. I want to talk about country risk, underwriter appetites, changes in the environment, which is, we'll touch on what Rebecca's been talking about, but I'm not going to go into the detail. As I said, I'm no economist, I'm afraid. But we look at some of those risk analysis factors, those risk factors which will impact on credit insurers' appetite for the world and future opportunities and challenges. And even Willis now, we're getting into the analytical area of artificial or human intelligence and looking at an analytical tool that we've developed, which we'll throw in at the end, and obviously any questions. So I'm trying to do this two-handed, so one-handed. My apologies. Oh, there it is. Okay. I was asked to look at the world, credit insurers' view of the world. So we looked at both trade sectors and the countries. Trade sectors here is quite interesting. This is AIG, just as an example. I've skipped a slide, sorry. That's better. Asked to look at credit insurers' view of the world. This is from Allianz, quite fresh off the press. The colors are fairly obvious, I think. High risk red, good risk green. Interestingly, little old UK in the orange, which is in the higher risk band. I do wonder whether that was downgraded as a result of the events of the last week, or whether that's going to be a further downgrade, depending on what the clowns in power do in the UK, but that's getting political. The basis of this is a mix of obvious strengths, economic strengths, forex reserves, political stability, and a lot of the factors Rebecca's mentioned. Rebecca, you didn't talk too much about fraud this time, which is obviously a big issue and the transparency of a legal system. So credit insurers take a lot of those factors into account when assessing the risk of trade in different countries, but it's quite depressing to see how many parts of the world now are in the deep red. I think we have 8 countries downward and only 2 going upwards, which I guess is not really surprising when you look at the events of the world now. WTW, as we're now called, published 3 times a year with Oxford Analytica, a country risk view of selected countries as well, which we're happy to make available to members if anyone gives me a shout, because that's based on selected countries based on our client requests. So if you've got a particular country anyone's interested in, we can usually get it added into the mix. That's then topped up with bi-weekly updates. We looked also, when asked to look at the view of the world, we had to look at trade sector appetite, because credit insurers have a very different view of the world depending on what sector you're in. This is too small to read, so don't even try, because I can't read it even on the big screen. But obviously, if it's shared later on, I think, Claire, you'll be able to magnify it and read. I think it's quite interesting view. There's a number of very obvious sectors. This is AIG's heat map. It's from their Q2. We're waiting for the Q3 one. Some of you may have experienced in applying for trade credit insurance, some of the sectors are rather more popular than others. If you're trying to get credit insurance in the construction trade or sales into retail, and in certain other, shall we say, challenging sectors, it's quite difficult, or very difficult, to almost impossible. But it's not fixed in stone. All these credit insurers will recognize there are good risks in tough sectors. And what's interesting, and this is a light to the credit management, there are always good companies in really, really tough sectors. And usually it's because they have very good credit management and the ability to manage risk in their challenging sectors. We have some insurers who will offer terms only for one company in a sector like paper, pulp, printing. They will stick to one client and not share that capacity out beyond that one client. The better credit managed the company, the better chance it has of getting quoted in these tough sectors. Other insurers will have different views. They may be colored by their own experience of clients and their current exposures and the loss record. This is our role to identify where the best sectors are. That's what a credit insurance broker is for. But interestingly, despite all the doom and gloom that we've just heard about, sorry, Rebecca, the credit insurers' appetites are still there. There's plentiful capacity. There's plenty of reinsurance capacity out there. But per the ICSA conference, which has been going on in the last week, lots of capacity, but it's likely to be very selectively aimed. And I think this heat map gives you an idea of where that would be aimed. If you're coming in with good capacity in the IT electronics sector where prices have gone through the roof, then we've generally got good capacity. If you're coming in for construction risk for middle level house building where mortgages and debt is going to be a big factor, then you might be whistling in the wind. Moving on, that's a version of next slide, please, because I can't find the button. Okay. There are quite a lot of factors coming in here. We've got a nice phrase there, new and returning considerations. And I think, again, I quote you, Rebecca, because that was a really interesting point about inflation and interest rates. Those are actually the fundamentals that we're looking at. Some of us, not many around the table looking at the audience, some of us are older enough to remember the 1970s. You know, the oil price crisis and the IMF support for GB PLC, then the 1970s and 80s inflation. I remember mortgage rates of 18%. Not to mention the industrial strife of those years. It's having a serious impact. And when you move this, focus this on credit insurance, credit-insured credit risks, it's quite scary when you look at what may happen to many companies, and we won't get into the debt-laden zombies. None of these guests, inflation, interest rate, industrial strife, should we say, are none of welcome returning guests at the party. It's quite a scary time. So the combination of rising interest rates, energy costs, on top of the much higher debt burden companies have these days compared to what they might have had in that period, could be potentially catastrophic. I think The Economist last week headlined an article, "A reckoning has begun for corporate debt monsters." What a good phrase. As rates rise, how messy will the squeeze on business get? It's quite a big article, but they reckon there are about 443 zombie companies, up from 155 a few years back, but a much larger number of merely very unfit companies rather than completely undead. It's a good article. I'd recommend a read there because it's a real illustration of the debt problem. And if interest rates, private equity funds are often on uncapped interest rates, which gets, and they are not often happy to support companies. They'll drop a company if it gets into trouble. They're not long-term investors. For credit insurers, forecasting bad debt numbers and hence claims on their policies, that's becoming increasingly difficult because so many factors impacting at once. We've only highlighted a few here. Again, I'm not an economist. I'm not going to go through the individual items. but all on the back of a 2-year COVID pandemic, which had such a negative effect on so many businesses. Some did okay, we have to accept. Some, again, the electronics business and the computers, home delivery, laptops did extremely well, but many other businesses were dead, closed down, shut down, and amazingly, so many survived. So contrary to expectations, that didn't have the negative effect on credit insurers. A year into the crisis, they were expecting a tsunami, was the common word, which I've covered there. Tsunami of claims. It didn't happen. In fact, they had a better loss record during the 2 years of COVID than they had for years before. 2021 was better than 2019, mainly because the government support for businesses kept, should we say, that those zombies kept those high-risk companies, the living dead or the undead, alive during 21, 22, and claims have not occurred, even to the extent that premium rates started to soften. Companies in the credit insurance world started to get more competitive, and there was a real fight for business. Again, I stress, in defined sectors, only in certain sectors, not everywhere. Some new markets came in. We've got Liberty Insurance now operating in Europe, which is a really big capacity provider. But we did have other insurers pull out, with Zurich pulled out, but that was if you like, a geopolitical issue. They hit some political risks they didn't weren't comfortable with. So it's getting quite competitive up till about somewhere in March, when Russia marched across the border. Capacity was good until then. Competition returned with that vengeance until Russia happened. That has made a big difference because Russia was heavily exposed. And I think the message we've had, and I'll go on to the future in just a moment, that long-term partnerships with insurer are key here. We talked about underwriter appetites in time of uncertainty. Underwriters during this last 6 months of Russia have stuck with many clients who they've had a long record with, a long track record, and have built a good partnership with, knowing those clients are well credit managed and will do everything they can to minimize loss. Those partnerships have paid off with cover being maintained or claims being met. Interesting time. It's all based on trust that the insurer will manage and mitigate risk sensibly, and insurers will support that if that's been demonstrated. That's better with our kind of excess of loss insurers because interests are aligned, because if you've got an excess of loss credit insurance, you're taking a very big first loss. So inevitably, you're going to look at you're protecting your own balance sheet first in line with the insurers second. So underwriter appetite is much better for long-established sellers than and those on that sort of program than those coming in. If people come in now to seek cover in the high-risk sectors, in the high-risk territories, very hard to get capacity. But at the moment, still, I have to say, reinsurance capacity is still plentiful. Claims are still low. It's a profitable profitable sector for the credit reinsurers. But what's going to happen next? I'll probably turn back to you, Rebecca, for that one. So, thank you. So these are the risk analysis factors set out. They've been better explained by again Rebecca earlier. We haven't got economists on the team here. But we agree really that country risk ratings are based on a combination of trade, political, and those legal commercial factors I referenced, the corruption. Ultimately, they all have to take into account as they impact the ability of a company to pay its trade debts. I grew up on paying claims for the UK's export credit agency in Zambia, which just ran out of currency. That was also a major copper provider. So they impact the ability of a company to pay its trade debts and a credit insurer to insure against that non-payment. Exposure to damage to our trading relationships is another factor here, and I'm going to touch on Brexit. Sorry, we have to say that for our UK colleagues. The hidden cost of this is really only now becoming more visible. And if we get into a fight over Northern Ireland Protocol, we're going to jeopardize trade with our biggest trade area, Europe, not to mention a falling out with the US, with Joe Biden's to be believed, no trade deal, get that. Interesting times. So as we go forward, what's the view? This is us trying to put a crystal ball together. I think I'm not a technological, I'm not the best to talk about artificial intelligence, struggle enough with my own sometimes. But I mean, AI, fintech, in our space in the trade finance world, there's fintech companies popping up all over the place. Undoubtedly, that all of this artificial intelligence will improve analysis and visibility of risk, but I do question whether it can replace a good credit director for a bigger problematic risk. You can do it on the mass numbers, but can you do it on the complex ones, which require to take into account the qualitative factors as well as the quantitative? Even companies like Willis Towers Watson, WTW, as we're now known, which rolls off the tongue well, we're now known as the analytical insurance broker. And we're using and recently launched our own analytical tool to measure default probability, using skills developed in quantifying risk across many insurance classes. If I'm allowed to give a quick explanation at the end, I've got a couple of slides on it just to illustrate. She's nodding. Thank you, Claire. But the ability to use tech to manage risk permits better use of in-house captive insurers. This is our third header down there. I don't know if any of you in the audience have got captive insurers in play for their general insurance or their credit insurance. It's a very tax efficient and useful way to take a first loss, to take a deductible, and to mitigate the premium that's being spent externally, to reduce it, particularly if your loss record is good. It allows you to maintain or increase the risk share to mitigate that premium, but it also helps you align risks with a good credit insurer. So if you're taking the first loss and the credit insurer's sitting either on top of that or alongside that, you'll find a much more partnership-based approach with them. To get away from that, I like to say, old-fashioned view of credit insurers being the umbrella that gets taken down when it rains. The pressure on capacity is going to grow, though. I think the inflation is the other factor that we want to touch on. Inflationary price increases, we're seeing with a lot of our clients, prices going through the roof. Not just necessarily in the high-tech world, in some sectors that you wouldn't have expected, where there's a shrinking market. Capacity provisions, I came across one the other day in paper, capacity provisions are pushing up pricing. So we're seeing inflationary price increases, puts pressure on individual policy, credit insurance policy, and individual customer credit limits. So we're finding a lot more demand for top-up cover, or even syndication for the bigger risks, where an individual insurer just is capped out or maxed out on what they can do on a particular sector or particular customer or client. It's often driven by banks, because we've seen an huge increase in use of trade credit insurance by banks. They tend to buy a trade credit policy with a maximum liability to match the facility limit, which in the way we would assess it is overbuying, because we would tend to look at a policy based on likelihood and severity of loss. That's sort of standard insurance methodology. But if you're using a bank, they tend to want a policy limit to match that facility limit, which tends to use quite a lot of capacity. Quite interesting. But the banks if they get the wording right, and this is a real complex area that's really evolving with the Basel III and the capital regulatory requirement in the EU, the banks can get capital relief if the credit insurance is worded right, which can make a huge cost difference. And obviously, with the way interest rates are going, any advantage is a good advantage. Lastly, we touched on ESG. It's not my subject. I know Willis have got quite a lot, sorry, WTW have got quite a lot of publications on ESG. But in our sector, we've seen insurance markets refusal in the past to take on coal risks. This has expanded to potentially all fossil fuels by some. We know that UKEF, the UK Export Credit Agency, ceased funding new overseas fossil fuel projects back in April 21. We've seen the Munich Re syndicate, that's not Munich Re, the big reinsurer, that's their syndicate in Lloyd's, ceasing writing oil and gas business from January next year. Munich are a big leader. We expect others to follow. And that's interesting, obviously, because there's going to be a huge pressure on trying to keep oil and gas trading with the energy shortages we've got at the moment. Quite scary times. But at the moment, the trade credit insurers are still there. They're still supporting business, and they're still able to underwrite. I'm going to touch on, thank you, on trade credit quantified. This is a tool we developed. If we can go on to the next one. Sorry, next slide, please. Apologies. Thank you, Claire. This is a relatively simplistic tool. It's not complex. It's powered by the Allianz Trade, Euler Hermes Oswald. We use their open source data. They provide the buyer data and ratings. And then we overlay it with a bunch of economic data, and we provide modeling. Using modeling, which we've done for all sorts of other, we do it cyber quantified, and we do quantified tools for various risk classes. And we've created a model now for credit risk. It's not the top end. It can't adjust it according to interest rates, which is a sadness. I'd like to be able to change that and sort of change the dial and get a different score. But very simple terms, it just needs 4 bits of data. Normal corporate, you can get straight through your ledger. Just buyer name, address, country, and exposure, credit limit. In theory, we can go up to 20,000 buyers, but we're trying to limit it because at the moment we have to, it's a test case. At the moment, we have to manually cleanse the data. So as everyone knows, getting the right legal identities can be a real issue. So we then show percentage probability of losses. We do 4 bands, classic sort of good, bad, indifferent. A chart showing the percentage of buyers in each country broken down by risk bandings per country, top 10 buyer grading. So you'll end up with something like 75% probability of losses totaling 55,000, 50% probability annual loss could hit 218,000, and so on and so forth down to 10%. It's a way of challenging people's credit insurance buying. Is it right? Is it structured right? Is it set right? Are the deductibles right? And if we go on to the next one, you get me to it. It draws on 14 million historical data points, and it's something of a crystal ball. It can't take into account black swan. It can't take into account wild card events such as we've seen recently, the pandemic, Ukraine invasion. We can't forecast those kind of unexpected events, but in a normal environment can predict probability of loss across a wide range of transactions with some economic variables built in. And if we take into account the ROI, we can begin to see the likelihood and cost of losses. Because it puts real figures to the potential risks within a customer base, we can easily identify what is bearable and where a company's pain threshold is. To be honest, it provides us with a bit of a USP as well, because we've got leader advantage here in this one, trying to provide an in-depth analysis that they won't get from other brokers at the moment. So this is our new tool. It's the analytical broker, WTW, partner with AICDP.
Thank you very much,
Richard. Sorry, slightly ahead of time there.
No, that's not a problem at all. I'm sure there's going to be some questions, so I wouldn't worry on that score.
I saw people writing, so I shouldn't be worried.
No, that's fine. So if you have got any questions, I'm now going to open the floor up. So if you have popped a question in the chat facility, I will be coming to ask if you can unmute and ask your question. So I've certainly found the session this afternoon really insightful. Certainly the essence of ESG being mentioned by quite a few presenters this afternoon. I think that's something that we all need to be a little bit more aware of, a little bit more mindful of. Rebecca, certainly from your presentation that you've discussed this afternoon, is there anything that you can see sort of on the horizon within the next sort of 6 months, that out of everything that you've spoke about today, which really needs to be the key factor for everyone to take away from today?
I think probably inflation, and it says it feels like that's stating the obvious, but I think inflation is the outcome of everything else. As we transition to more sustainable ways of working, transition away from fossil fuels, as we try to cope with the ongoing conflict between Russia and Ukraine, all of those things are generating rising prices. And as Richard said, he's got clients who are saying that there are massively increasing prices. I was speaking to export credit agencies in Dubai a couple of weeks ago, and they were saying that they're seeing particular products and particular sectors with disproportionately big limits needed on their credit insurance now, and you know, that's going to start excluding some organizations from accessing credit, and I think if we look at the knock-on effects of inflation globally and how that could then affect political stability, because you're actually seeing what's happening in the UK right now is a political reaction to inflation that has then created an economic reaction, and the net effect of that has been actually to make inflationary pressures long-term worse. You know, so I don't think we can run away, which is why I put that first. I think inflation is going to be the big story of the next 12 months.
Thank you very much. Question for you, Richard. With your new system that you've been speaking about this afternoon, if anybody's interested in finding out any more, how's best to get hold of you? And do you run any demonstrations? How best is it for people to find out more information?
Okay, I mean, just contact me. You've got my contact details at the end of the slide, or Scott. We'd be very happy to arrange a demonstration, either a live one, or to be honest, we do the simple screenshots and we take it into about a dozen different slides of showing a typical example of how it works. If anyone is prepared to pull together the data from top 200, top 300 of their customers and give us just names and city, country and credit limit, we can actually run the model. There is no cost at the moment. It's a trial service. We're working to see how it goes. Allianz are very pleased with development so far. It launched in the US. And we've opened it up in the UK as well and beginning to dabble into Europe. But generally at the moment it's a US-UK initiative, but we'll hopefully, if successful as it's been, will continue to grow. But it's a free offering at the moment to open a dialogue. To be honest, it's a sales pitch. It's a tool to get in to talk to people, but it comes in with real analysis.
Okay.
Rather than just my view of a risk, it actually says, look, the numbers here, statistics don't lie, do they?
No, thank you, Rebecca. We have had a question come in for yourself. That they've just sent a message to say, Rebecca, you mentioned that the global economy needs to shift how it operates in order to become more sustainable. Do you have any predictions on how it might change or evolve?
So I think the prediction on how it might change or evolve will depend a lot on whether or not we can reintegrate Russia into the global economic system, and whether or not we want to, and whether or not that then triggers a separation of the ways, and we start to see, if you like, almost a separating out of trade finance, trade and payment systems. So I think if we take my broader definition of sustainability, which is about economic sustainability as well as social and environmental sustainability, then the economic stability and sustainability of the world is fragile, because we are transitioning to new ways of doing things from a technological point of view, which is actually creating uncertainties in the way in which great powers operate with each other. And that's the big picture. If we then take down that to the effects of the Russia-Ukraine crisis, what's happening is that's having a knock-on effect on the global economy. It could separate things out. I don't know that it will completely, because China is still very much wanting to make sure that it is able to exercise its foreign policy through economics. But I think if we then we have to be very careful how we manage the economic risks of the next 6 months, as I've already said. But I think the issue will be whether or not we dump a lot of the Paris agreements, the commitments to net zero and so on in the more specific environmental sustainability context of my answer to that question. Because if in the process of recovering from the shock that has been the oil price increases and the invasion of Ukraine, if in that process we drop all of our saving the planet targets, net zero targets, sustainability targets, then the risk is we go back to a more febrile normal. And I think what we have to do is use this as an opportunity to, while we're in an inflationary environment, actually go the whole hog and start to look at how we transition to cleaner energies. That means a big geopolitical picture of where we get our base metals from, and that's a really conflicted area. I was interested to see that that President Biden was in Chile, Peru and Colombia. Those are three of the major producers of the actual lithium as it comes out of the ground. It gets exported to China, it gets processed in China, and then it gets shipped around the world. But actually those are three very important sources of lithium, and obviously there's a political element to going in, or a geopolitical element to going and talking to those nations. So short answer to that question is it's going to be difficult. Longer term answer is it's geopolitical, and a lot will depend on where we get to in terms of my game matrix in the next 6 months.
Brilliant. Thank you for that. Is there any more questions from any of the delegates that we've got with us today? If you want to unmute yourselves and ask the question, then please do.
Hi, it's a question for Rebecca. Can you tell in what way or to what extent the figures that you have shown are influenced by the, let's say, irrationality of the markets, where generally markets are completely overreacting to the uncertainty that we're currently seeing and are basically pricing this into the commodities?
Yes, I mean, obviously that's what's pushing up commodity prices, and you know, to the extent that animal spirits float around in financial markets, there was a lot of nervousness in the whole situation as it started to unfold from January onwards. I think the increase in gas prices and oil prices has created a fear. It's created the fear index. We've got the return of the fear index in global markets, and it has had that sort of multiplier effect. I think the risk now is that we start to see that going into bond markets because of the inflation that's coming through. And now we're seeing, you know, I mean, I read somewhere last week, and I'd have to agree with them, that the mini budget effects in the UK last week on global bond markets were just a taste of what the potential is as economic policy makers start to think about how they recalibrate their economies, because at some point this set of decisions has to be made. And it's interesting, but if you go back to the global financial crisis, I can remember immediately after the global financial crisis, everybody saying, we haven't seen anything yet. This isn't the settle down. This isn't the final game in terms of where we're going to end up after the financial crisis. There's too much debt in the system. There's too much reliance on the dollar. You know, we haven't seen a shakeout of this economic nationalism that started to come through, and as a result of that, I think we're now seeing, because of a political crisis, a geopolitical crisis, we're starting to see that affect markets as well, and that's super worrying. You know, economists aren't called the dismal scientists for nothing.
There's certainly some negativity, but I guess there's an interesting element in there where we basically see a fundamental shift, aren't we, in terms of where do we get our energy from in the West? Yeah. To renewables, and also as Biden in the US certainly is pushing for more homegrown production to get less dependent on China, because that could be potentially the new battleground next year, as you alluded to. So yeah, I would agree, a lot of uncertainty remains.
A lot of uncertainty. It's fascinating. I mean, you know, if you are a political scientist / economist, as I am, it's super interesting times, and a privilege to be able to sit on the side and watch. Unfortunately, there are a lot of people that are going to be damaged by all of this globally, and we are living in challenging times. And I think if we acknowledge that and say this is actually the result of the history of the last 12 years, then we can get somewhere. And one final thing I would say on all of that is that we saw, as a result of the global financial crisis, this rise in populism, this economic nationalism. That economic nationalism is what is working through now. Russia is profoundly nationalistic, not just in terms of its political stance, stance, but in terms of its economy as well. China, America, you know, and the UK now as well has become profoundly nationalistic, and it means that those institutional structures of multilateralism have gone. And the only one that's left actually is the European Union, and that's the only one that's holding together in a robust way. And even that's got Hungary and Poland and sort of.
Thank God Britain is out of the European Union.
From where Richard and I are sitting, I'd say absolutely not. If you yeah.
Yes, indeed. Indeed, but I think we have to be careful not to make the you know, the bill without the customer. You know, there's still people and populations in there that are increasingly under pressure, having eroding living standards and stuff. And I'm just wondering for how long that can go on before people start so far and no further. I mean, we already see this with the trade union movement in the US and this country. You know, all the things that are happening on the ground. At some point people will start, we can go so far but no further, and if this whole crisis means a further eradication of living standards in the West, it will create social unrest.
I think that was, and that's why I'm so concerned about inflation.
Yeah, that was my allusion to the 1970s as well.
Yeah, and the 1920s actually. I don't remember that one. No, I don't either, actually, but
yeah, and everything is moving a lot faster, isn't it? And there were some statistics that somebody quoted where, God, in the Great Depression, I think it took the labor movement about 5 years to organize themselves and push back. And apparently, as a result of the most recent crisis, it took in the US the trade union movement about 6 months to organize and push back. So I would say certainly things are speeding up in terms of cause and event and all these interactions that we're seeing at the moment.
Social media for you.
Thank you very much, everybody. If there's no other questions, I'm gonna call this meeting to an end. I would just like to say that if you are in Dublin next week for the World Credit Congress, AICDP will be having a stand in the exhibition hall, as will quite a few of our corporate partners, so Copilot, Bakering. They will be there, our members will be there. So come and say hello, come and make yourselves known. It would be really, really good to see quite a few of you over in Dublin next week. And also don't forget the breakout sessions that are taking place on day 2. I know Simon mentioned his Essence of Credit Risk event, which is taking place on day 2. These are a really good opportunity to get in the room with very, very experienced, knowledgeable people who can help you to make decisions for the future and also get the help and support you need. So hope quite a few of you are going to be there in Dublin next week, and look forward to seeing you if you are. So that leaves me just to say thank you very much to Rebecca and to Richard for your presentations this afternoon. Really, really insightful, and we will be making a copy of this webinar available on the AICDP website, certainly by Thursday. So it normally takes a couple of days to come through. So we will send a note out to everybody, and we'll also pop a note in social media as well. So